So I would like to welcome everyone to our fourth panel of today on the future of carbon markets. We'll be talking about the future of these markets after first learning about the current state of affairs in three really important carbon markets: the EU emissions trading scheme, the California cap and trade market, and the regional greenhouse gas initiative. We're going to discuss how well these markets are performing, what kinds of reforms might be needed, and what investors believe about future carbon prices, and maybe also after comparing these systems, what are some lessons that one system could learn from the other. And to that end, I'm very pleased to welcome four esteemed panelists, some of whom are regulators or have contributed to the market design of these carbon markets, and others are investors and market participants. So it's a rich set of perspectives. So the way we'll do this is that each presenter is going to give a brief presentation. I'll first introduce the speakers before that. And then I have the pleasure of asking the panelists a couple questions. But of course, finally, I want to reserve a lot of time for you, the audience, to pose questions in the Q&A box. I wanted to start with Katie, but I don't see her on the panel yet. So I think what I'll do is let's move on and switch the order slightly and start with Casey Dwyer. So Casey is a partner and portfolio manager with Enhancements Capital in London. He manages the Enhancements Climate and Energy Transition Fund, which is a thematic hedge fund focused on equity, carbon, and commodity expressions in the energy transition. And Casey has a lot of experience in fundamental research, in risk management, carbon emissions, energy equities. He's a true expert on carbon markets and specifically the EU emissions trading scheme. I'll also mention that Casey has an MBA from Wharton, so welcome back. And Casey, the floor is all yours.
Thank you, Professor. And I wore my Wharton jacket just for the occasion. But I see that Katie actually joined, so I'd be happy to just take a break and let her go first, and then we can step into the EU after that, if that works.
That sounds very good. That sounds very good. So let's do a little switch back in terms of the program. So I have the pleasure of introducing to you Commissioner Katie Dykes. Katie has been the Commissioner of Connecticut's Department of Energy and Environmental Protection since 2019. She previously served as the chair of Connecticut's Public Utilities Regulatory Authority from 2015 through 2018, and before that as Deputy Commissioner for Energy from 2012 to 2015. So a really rich set of experience as a regulator. But also importantly for our panel today, Katie is a member of the board of directors of the Regional Greenhouse Gas Initiative, or RGGI, and she served as the chair from 2014 to 2017. So Katie, we are very much looking forward to learning more about RGGI, and I'll hand it over to you.
Terrific. Well, thank you so much for that introduction. And it's so great to be with you today. It's a really exciting time to be talking about carbon markets and carbon pricing. I'm especially proud of the role that Connecticut has been able to play over many years as a charter member of the Regional Greenhouse Gas Initiative program. That program continues to evolve, and we're in a program review process that's just kicking off right now, so it's very timely. But at the same time, we have a real history now and a legacy of the performance of this program over several years that I'm excited to talk a little bit about. We have a few slides today, which I'm happy to share that can go into a little bit more detail about the RGGI program. But you know that experience that we've had with RGGI continues to inform some of the work that we've been doing and thinking about carbon pricing and carbon markets in other sectors, including transportation. And let me just pause. I apologize. I'm just coming from an event with Governor Lamont, so it's been a little bit of a hectic day, and I can't recall if I should share my screen or if you all have the slides.
If you could please share your screen, that would be great. And thank you so much, by the way, for joining in between all kinds of board meetings and exciting activities. So
it's been a little hectic, but this is such an important topic. So let me see if I can get this to work really quickly. Here we go, and let's see if that comes up. So you should be able to see our the slides. Is that coming up okay? From the RGGI program. Let's see. Here we go. All right.
I see it now.
Okay, great. And oh, sorry. Let's just go from here if that works. So essentially what you can, let's actually, no, I should do this for real.
Just press F5.
Thank you. Thank you. Hopefully that'll come up. All right, so the Regional Greenhouse Gas Initiative program, again, Connecticut was a charter member. When we started, it was just a handful of states in the Northeast, but over time, the RGGI program has expanded in a significant way. So now we are a coalition of 11 states that are participating in the program. Although, by land area, it's just that corner of the Northeast, but in terms of our population that's covered and the percentage of GDP, it's an incredibly impactful range of jurisdictions that are participating. 18% of the U.S. population, and if we were a country, we would have the fourth largest economy in the world based on nominal GDP. So we're really proud of what this means. And at a time over the last couple of years when there has been, there's a lot of focus on subnational action on climate. It was, I think RGGI had a lot of especially a spotlight on it for this reason, given its regional impact. The program is a cap and invest program. It covers the power sector and the participating states. The power generators that are covered are those that are 25 megawatts in capacity and above. And importantly, that are emitting fossil or greenhouse gas emissions. An important feature of the program is that each state, we have an overall cap that's set on the regional level. The cap in 2021 is 119.8 million tons, and that cap is subdivided among the participating states. And each state issues allowances up to our portion of the regional cap. And we auction the allowances off in quarterly auctions. And we provided for a lot of flexibility mechanisms around the allowance auctions so that they're fungible across state borders. We allow for banking. We have an active secondary market that's built up around the RGGI allowances. But some really important decisions were made when RGGI was first started. One was whether we should give away the allowances, and the decision was made to auction them. And that has been a really important feature. I know for this is a program that as we contemplate all of the partisan politics that unfortunately that has been layered over action on climate in some sectors, it's really important to note that the RGGI participation is bipartisan, and it's been very durable. With the exception of New Jersey, which left the program for a time a couple of years ago and has returned to the program. More by and large, even as we've seen transitions from administration to administration in state capitals, or from changes of party control in state capitals, participation in RGGI has been fairly consistent among those states that have joined the program. One of the reasons, I think, is because of that the program is generating proceeds, a significant amount of proceeds, which are coming back to states to determine how to invest them. And I think that decision-making around proceeds investment is a critical piece of what anchors this program, has made it very, given its staying power, because each state is investing those dollars in critical areas, and it's delivering a lot of policy benefits that make it a very attractive program to continue. So 90% of the allowances are distributed through quarterly auctions. We do have some set asides that are provided for in various state regulations. We've seen an increase in the allowance value up to $9.30 in September of 2021. The program over its lifespan has generated more than $4 billion in proceeds. So when you think about what that means in terms of investment in each state over time, you can see why I think this has been such an important centerpiece of states' clean energy and consumer benefit programs and climate programs. In addition, we've seen a robust secondary market built up around RGGI that is closely tracking the auction prices. I think this slide just shares some of the characteristics of our auction. We have had a commitment through the program. I would say another reason for its success and durability is that we've had a commitment to doing program reviews on a regular basis. And so we're entering into now our third program review. But in our past program reviews, we've engaged with stakeholders, with market participants to find out how we can strengthen and enhance the program. And what you see on this slide are a few of the improvements and enhancements to the market design that emerged from our program review discussions. So first, a cost containment reserve, which, because obviously this is a program that impacts retail electricity rates as well as wholesale electric prices. That's a public good, and we have a lot of sensitivity, of course, around the impacts to consumers and trying to mitigate against price volatility and price swings for a critical resource like electricity. And so to respond to that, we've installed a cost containment reserve, which allows for an injection of additional allowances into the market, an additional supply of allowances into the market if the clearing price is above a certain CCR trigger price. So it's been rare that we've seen that CCR being utilized. But we also, in the recent, the last program review that we did, we engaged stakeholders and ultimately decided to create a parallel mechanism, kind of the mirror to the cost containment reserve, which is an emissions containment reserve, to ensure that if allowances fall below a certain price, then where additional carbon reduction it turns out to be cheaper than what we would have anticipated when we set the cap, then the allowances, additional allowances can be withheld in that auction. So those are two examples of things that we've put in place to continue with the market design, but have some of these safeguards to protect consumers from price volatility, as well as to provide assurances of continuing carbon reductions. Here's just to give you some of the market stats in terms of where we've seen clearing prices in recent years. Obviously, we've seen an increase in most recent years, and I think there's a lot of different reasons for why we can speculate about where what's driving auction clearing prices, but this gives you some insights into how those prices have been changing over time. And as well, we carefully monitor participation in the auctions. I think this is such a great example of states effectively running competitive markets. And after each quarterly auction, each state has two designees to the board of directors. Usually, it's an environment agency head and an energy agency head or a utility commissioner. And we have a market monitor who reviews the auction results, is monitoring what's happening in the secondary market, advises the board members, the state agency heads on the competitiveness and any irregularities that may have been observed in the auction before we certify those results. And so it's a really important part of the process to have that oversight. And these are some of the things that we are monitoring as we review the auction activity. And then you can see here some of the information about the secondary market and some of the performance that we've seen in recent years. Again, robust participation in the secondary market. We think that provides a lot of flexibility for compliance entities and others. In terms of what for their strategies of how they want to purchase their allowances to ensure compliance. And again, there are a lot of different reasons that we've been hearing and discussing in terms of what's affecting recent price movements upward. Certainly, we've seen some increased activity by non-compliance entities. This may be driven by the initiation of our latest program review. Each program review has been an opportunity for us to review the cap trajectory and consider, of course, as we review the trajectory, how it aligns with the various energy goals and climate goals in the participating states. So it's reasonable to anticipate that we may see the opportunity to strengthen and or tighten the cap in the upcoming program review, which would affect the supply of allowances. Electrification of the energy sector, it's really exciting. The event I'm just coming from is about EV charging, and we know that's going to drive a lot of demand for electricity. We need to ensure that the pace of decarbonization of the electric grid is keeping pace with increased demand for electrification, beneficial electrification. That's certainly maybe on the minds of those who are participating in this market, and so on and so forth. But again, these are trends that we hear being discussed, but and that we're thinking about out there. But when we do a program review, we're doing extensive modeling of the energy sector, looking across the power generation mix across the various states, taking into account the clean energy deployments and goals and energy efficiency investments and behind the meter investments and so on and so forth, to model what we think is a reasonable future, and weighing the additional carbon reduction we need to meet our targets against the expected impact to retail electric customers. So that's a very, very quick, hopefully, overview of the RGGI program. But I'm really appreciative of this opportunity to kind of share what our experience has been. Again, I think at the state level with this program, it's been a tale of kind of marching along, demonstrating, the inherent benefits of regional and market-based approaches. I'm very proud of the track record that we've had with the RGGI program, eager to participate in the discussion today. And I especially want to encourage folks, if this is something you're interested in, to get involved in our program review as it's just kicked off. You can find out more on our website at rggi.org. Thanks so much.
Thank you, Katie. This was great. And I hope the audience, you all are going to appreciate that. We just got some education on RGGI, but now you're going to hear about other carbon trading systems, and you'll see some similarities, but also some differences. And so to that end, let's move to Casey now. I already introduced him. Casey is a real expert on, among many other things, the EU ETS. So Casey, the floor is entirely yours.
Thank you. And it's really great to be here on this panel. I'm really excited to have a great conversation. I thought I'd run through some details about the EU ETS, and I'm really happy I get to go second, because that means I get to comment and make sure that I cover all the right material. So let me just share my screen. That is here. And then, of course, because I work at an investment vehicle. Okay, so can you guys see my screen all right? Okay, awesome. So I put this slide together in terms of fundamentals for the European Union. And as a market participant, as a speculator in the market, a lot of the slides that I put together were about price formation. And that might help answer some of the questions that, or maybe some of the discussion that we can have later about what drives price in these markets. But just to kind of add on to the comments that were made just about the RGGI market. So the European market is I think I would want to say the standard carbon market that investors look to when they try to determine compliance carbon markets globally. It's the largest market. It's about 1.3 billion tons a year. It works similarly to the RGGI market with a couple of key distinctions. It has additional sectors that is not covered under RGGI. So in addition to the power market, it has heating, refining, metals, cement, aviation, and some other mixed uses. The auction mechanism actually occurs nearly daily, and has a fantastic component, which is uniquely European, which is the auction volumes decrease during the month of August and around the Christmas holidays, which is a totally unique thing that I think is very, very European, I must say. There is no price corridor in the European Union. So unlike several other markets you'll hear about today, where there's a cost containment or a price floor, The European market doesn't have one. It does have something that is known as Article 29A, which is what I like to call a soft ceiling, which is basically a price at which additional credits are brought to market. It's very similar to the UK market, which I don't think we're going to discuss today, but there it is. And then kind of diving into the price element, right? And thinking about, okay, so we have these markets, right, where governments or kind of combined entities auction off supply and give supply out to entities, but what actually determines fair value and price? This is actually just, these are balances. We can go through this later. Balances, TNAC, right. So as I mentioned before, there are different market participants that kind of interact in the market to establish price. One of the items that in the European Union has for a long time been considered the fair value of carbon has been the price needed for a power plant to switch from coal to gas. Right, so if you think about decarbonizing a power grid, one of the, I would say, lowest hanging fruit that you can think of is, you have a power plant, it burns coal, you want to have a carbon price sufficient to switch that power plant to gas, which means that to some extent in Europe, the carbon price is tied to both the price of coal and the price of gas. It's a relatively complicated function because it's unique to every power plant and hedging requirements by various companies, but taking a big step back, as the price of gas goes up, and you'll hear a lot in the news recently about how, the price of natural gas in Europe is very high, the price that's then needed to switch to gas generally increases, right? It also depends on the price of coal, but anyway, so these are the charts as of actually July. They've changed quite substantially. As you'll notice, TTF prices at the top. We haven't seen those prices since the summer. Regardless, what the slide will show is that basically as you shift the input power mix, the utilities hedging requirements for carbon change. So that's one of these kind of initial pricing mechanisms that if you're thinking about, well, what is fair value in a carbon market, something that you can consider, right? It's the fuel switching kind of dynamic. And this is just thinking about how we actually, at a hedge fund level, think about it over the longer term, right? So in commodity markets, and not to get too much into the details, but you have forward strips of prices, and you can actually run models with those forward strips of prices to determine what fair value is, given what companies are doing in the future. So as I mentioned, if you're a utility in Europe, you may be hedging your exposure to power, gas, coal, and carbon 2 years forward, right? And so you can construct a futures curve that it is the implied break-even cost for carbon, and that's what this is. This is showing is just very simply, if you were to assume that carbon today needs to hedge out coal out of the European energy mix, carbon should be just under $250 a ton. Actually, I think that number now is even higher. This is as of September, but I think that number is I think it's $450 euro dollars today. So that just tells you that the carbon market is not $450 today, and that's probably a good thing for a variety of reasons that we can discuss. But the market does have the ability to kind of look forward to the future and say, okay, well, we want to make sure that we're optimizing gas over coal in 2023, for instance. Another pricing mechanism that you can think about, or a way to establish fair value in the market, is okay. Well, if a government, if the supplier of these credits is trying to incentivize certain policy, well, then we can look at other places on a carbon abatement curve and extract where we would find value, right? And so one of them, and this is a paradigm that we really like, is the transition to green hydrogen. It's very kind of central to the EU policy direction, and in order to establish that fair break-even cost of what is needed from a carbon perspective to generate green hydrogen, you can compare it to producing gray hydrogen. So gray hydrogen, at a very simple level, is you take natural gas and you break it apart, and you get hydrogen, you get carbon, and the carbon goes into the atmosphere and is bad, and green hydrogen is much easier. You take an electrolyzer, you run power through it, and you produce green hydrogen. They have different cost mechanisms and different power inputs, but if you throw it all in a model, you can basically get a 2030 cost for what it would take as a carbon price to incentivize people to invest in green hydrogen. That number changes with the price of natural gas, as well as the capex cost for green hydrogen. But I think €100, something like that, in 2030 is another fair value to think about. And then the last thing to kind of just to make a comment on, and then I'll pass the baton, is there are these other players in the market as well, right? So there are industries that are covered under the EU ETS, as mentioned before, in addition to power, and those have their own kind of abatement functions, right, and their own desires to hedge, and their own kind of cost elements for how much it would cost them to decarbonize. In carbon markets broadly, in European Union in particular, there's a process of free allocations, whereas companies, to incent them not to leave the European Union carbon zone, they are given allocations for free. There's been a lot of talk about a carbon border adjustment mechanism. We can have, I'm sure, a whole separate discussion on that. But until that kind of mechanism is in place, there has to be something to prevent what's called carbon leakage, which is if you tax industry in one jurisdiction too much, they're going to move to a different jurisdiction and import the goods. And so, anyway, all that to say, the industries that are covered under the EU ETS also have, each one independently has their own price mechanism. So I know an independent price of carbon. And the last one is investors and speculators such as myself. We have our own cost of carbon, our own kind of views of where carbon should go. I think that the interesting thing that's emerged is basically carbon as an asset class and as a use case for things that aren't necessarily fundamentally driven by price. So inclusion of EUAs in Goldman Sachs's carbon neutral commodity index, I think, is like a very classic and very straightforward way to present this information. Whereas, if an investor wants to buy a basket of commodities but wants it to be carbon neutral, they can buy the green carbon neutral index, which is essentially included EUAs or European carbon into the basket. And that then kind of through some really cool calculations that economists at Goldman have done, basically neutralize the cost of rolling the commodities. Anyway, a ton of information. All that to say, it's a great market. It's worth taking a look at, and I'm really happy to be on the panel.
Thanks, Casey. It's a great market, a very complicated one also. You didn't quite discuss all the details of the market stability reserve. We could talk about this for days, but don't worry, audience, we won't do that. But thanks for this comparison. So we traveled from the Northeast to Europe, and now let's go west to California. So I'd like to introduce to you Emily Wimberger. Emily is a climate economist with Rhodium Group's energy and climate practice. She analyzes the economic impact of climate change and policy responses, and provides policy outreach, for example, focusing on the application of the social cost of carbon. Before Emily was at Rhodium, and very relevant to today's discussion, Emily served as the chief economist for the California Air Resources Board, where she analyzed the economic impact of California's portfolio of climate change and air quality programs with a focus on carbon markets. Emily is an economist. She holds a PhD from the University of California at Davis. So Emily, over to you.
Great, thank you very much. Let me share, let's see if I can share my screen. Okay, did that work? I'm gonna
not yet for me.
Oh, hold on. It says, please try again in a minute. Arthur, do you have my slides? Or do you mind sharing them? For some reason, it's not letting me share.
Let me pull them up.
Okay. Well, I can get started a little bit. So I have from 2011 through 2018, I worked in some capacity on various issues related to California's cap and trade program. And I think an important distinction, and I think this is something that Casey mentioned, is that in California, the cap and trade program is one policy and is a portfolio of climate policies. So when we talk about the cost of carbon, when we talk about the cap and trade program, we're talking about the cost of an allowance in the cap and trade program. And that's very different from the cost of a low carbon fuel standard credit. And so in California, it's very important to distinguish between what you're talking about. Is it the social cost of carbon? Is it the cost of an allowance is the cost of an LCFS credit. There's also the RPS, and there's a cost associated with reducing emissions in the power sector. So you can go to the next slide, please. Thank you. And sorry for the technical difficulties. A timeline of events. So RGGI does predate the California program, and I think you'll see a lot of similarities. And so there was a lot of interest in forming cap and trade programs in the heyday of Waxman-Markey, when everyone was thinking that there could potentially be a federal program. And so the origins of California's program are really from the Western Climate Initiative, which was a group of governors and different provincial jurisdictions that came together to talk about common principles. So again, you'll see a lot of commonality between the California program, RGGI, and the EU ETS program, with a few distinctions. So California is fully bilaterally linked with the province of Quebec. That means that allowances are fully fungible across the two jurisdictions, and that occurred in 2014. There was a hot minute when Ontario also was a member of the group, but then there was a change in administration in Ontario, and they revoked the cap and trade regulation. So now again, then they delinked. So now it's California and Quebec are together in the program. There also have been a lot of modifications made over time. So the original program began operation in 2012, but there were also, it really did start in 2006 when there was legislation in California that said, hey, we're going to have a 2020 greenhouse gas target. You need to hit 1990 levels by 2020. And that authorized there to be a market mechanism to try to achieve that target. Another big milestone was in 2017, there was new legislation passed that codified the cap and trade program through 2030, but did put a lot of restrictions and offered additional market mechanisms that needed to be added to the program in order for it to go through to 2030. So I'm going to talk mostly about the program as it exists today, but there's really sort of two main periods. It's sort of 2012 to 2020, and then 2021 through 2030. Okay, you can go to the next slide. Okay, so just generally speaking, so California's program is economy-wide. So similar to the EU ETS, it does cover, multiple sectors. It covers about 80% of California's greenhouse gas emissions. And then that represents about 500 entities with emissions, as you see right there. And so this is emissions generated in the state of California, and it also covers imported electricity, natural gas, and transportation fuels. So transportation fuels and natural gas came online a little bit later. They came online in 2015, and the industrial and generation was in 2012. So in terms of compliance, we do have free allowance allocation in California, and this was to prevent leakage. As Casey mentioned, if you sort of introduce a high carbon price in one jurisdiction, you will see emissions increase in other jurisdictions as economic activity in the regulated jurisdiction declines and moves elsewhere. So there is free allocation of allowances, and that was something that was stipulated in AB 398, that all industrial sources will receive the maximum amount of free allocation. It covers about 90% of their emissions. There is a declining cap, but that was really to prevent leakage and just to ensure the competitiveness of California industries across the board. Allowances can be traded between entities, and they're auctioned off quarterly. So we hold quarterly auctions, again, in conjunction with Quebec. So there's California allowances and Quebec allowances, and the purchasing entity does not know if it's a California allowance or a Quebec allowance. They're fully fungible. Offsets can also be used in the California program, and this has changed over time as well. So offsets have been a bit controversial in California. There are very stringent offset compliance protocols. There are 6 of them in California and 5 in Quebec. And the percentage of your compliance obligation that can be satisfied with offsets has changed over time. So up to 2020, it was 8% of your emissions could be covered by offsets, and these are domestic offsets. Then starting in 2021 through 2025, 4% of your compliance obligation can be offsets, and half of those need to show a direct environmental benefit to California. And then from 2026 through 2031, which is actually how far out the cap goes, then that percentage increases to 6%. So program cap, it declines the decline factor has increased over time. So it started at about 2%, and it's ramping up to about 4% in the current compliance period. Okay, next slide. Some of the more exciting stuff and talking about prices, and I think this is a really important piece. So how does the structure of the program really sort of drive prices or impact where we find the price of the allocation? And so there are a lot of provisions similar to RGGI in the California program to ensure that there's no market malfeasance and that that no one is gaming the system. So, and we also wanted to provide flexibility for entities in sort of procuring allowances, knowing that emissions might fluctuate over time. So we do have multi-year compliance periods, and that is really to help to smooth out emissions variations, and also 30%. So for 1 year, 30% of your emissions are due, 30% are due the next year, and then you figure out the remainder in the third year of the compliance period. So it gives entities a little bit of flexibility to reduce the cost. There also are very stringent holding limits. So you're not allowed just to buy as many allowances as you want in the program. There are holding limits, and it's by vintage. So for every year of allowance allocation, there is a specific limit on the number of those allowances that one entity can hold. We do have an auction reserve price. So Reggie's is $6 in 2021. California's is $17. So it started at $10 in 2012 and has increased 5% per year plus inflation over time. And that is, again, so that's the minimum price at which California and Quebec will sell them at auction. And there's a whole rigmarole about, exchange rates and who has the lower floor, which is a real whole fun thing, which the EU knows a lot about. But so that if there are allowances that are offered and the price is not at the floor, then those allowances are held back. And they're then, if there are two subsequent auctions where the price is above the floor, then those can come back in. And so again, similar to Reggie, that does help regulate sort of the price. Again, I talked about the limited use of compliance offsets. And we also do have a containment reserve and price ceiling. So again, this is something that did change with the passage of AB 398 in 2017. So through 2020, California had an allowance price containment reserve. So there was a set number of allowances that were taken from under the cap each year and placed aside in a reserve, and they could be offered for sale in 3 reserve tiers. Through 2020, no reserve sales they never occurred. But with the passage of AB 398, now there are 2 price tiers and a price ceiling. So the current prices for the tiers are $41.40 and $53.20. And so basically what happened is California took all those allowances that had been set aside from the allowance price containment reserve and populated these 2 tiers with those allowances. In addition, they held back some of those allowances, one third, and put those in a price ceiling. So at $65 a ton in 2021, if there's an entity that is short of allowances for compliance, they can purchase as many as they need at that price of $65. The rub is that then California will use those funds to ensure that they find additional reductions to match those tons. So it's basically, they're ensuring the integrity of the cap by finding reductions outside of the cap sectors for that $65 per ton. Okay. Next slide, and this is the really exciting one. So what has actually been going on in terms of the prices? So what you can see here is the orange line is the auction reserve price. So this is the price floor, and it increases 5% per year, as I said. And so historically, and there's a current auction and an advanced auction in California. So current auction is what you can use for compliance in the current year, and advanced auction are allowances for sale that you cannot use for compliance now, but can be held and used for compliance later. So what you see historically, and so 2014 was when Quebec and California linked. So historically, it's basically the prices tracked the price floor. That has recently changed, and there's been a lot of discussion about that, which I hope we can continue. But the past 2 auctions have we've seen the price sort of taking off. And there's a lot of discussion about what that means for the future of the market. So as I said, the decline factor is increasing. It's about 4%, 2021 through 2030. But we did see dramatic price increases in the last 2 auctions. The last auction was in November of 2021. In terms of who's buying these allowances, so the past 2 auctions, the last auction I think was it was slightly less. It was maybe $24 a ton, and that was 30% of the allowances were purchased by speculators. So there was a lot of discussion about what that would look like for the subsequent auction. Well, 20% of these allowances that settled at $34 were purchased by speculators. So it's not, there was some discussion about what this means for the program in terms of the stringency and sort of expectations for the cost of reductions in the future. But would love to hear a discussion more about that. But it is true. So, prices are varying across all of these different jurisdictions, and it really is a function of sort of the scope, the scale, the ambition, and a lot of these market design features really can impact the prices and where we see them settle up. And with that, I will end.
Thank you very much, Emily. So let's go over to Alex Rao now for the last presentation, and then we'll start our discussion. So we've heard about 3 carbon markets now, but let's for a moment, take the perspective of someone who's trading in these markets, and who better to ask than an experienced trader in carbon markets. Alex has 19 professional years working in environmental commodities, carbon markets, and climate finance. He is responsible for investments at Environmental Commodity Partners. Alex previously founded Climate Wedge, which is an independent carbon trading and climate finance investment firm, where he advised and managed direct investments in carbon and related environmental commodity markets for institutional funds. He's also an advisor to the California State Treasurer and Climate Bonds Initiative on green bond markets. Alex, I noticed you also have a PhD in physics from Oxford, so you really seem to be a true expert in many different fields. And I'm excited to hear from you, well, I guess in this case, about carbon markets.
Yeah, thank you, Arthur. And it's great to be here today. So as you mentioned in the kind introduction, so I've had the opportunity really to dedicate my career after a training in physics and science to the carbon markets, really, and what we would call environmental commodities more broadly. So very happy to be here today and just to reinforce the message that these are powerful mechanisms sort of on the policy response side to dealing with the problem of emissions. How do you price the negative externality and also actually incentivize some positive externalities from the production of clean energy or clean fuels? So great to be here. I've had the opportunity through my career to trade most of the world's markets. So the EU ETS and some of the project markets that predated that under the Kyoto Protocol that would sell into the ETS, as well as California's cap and trade program. So disclosures alongside Casey and others, we do have positions in these markets. So just want to honor the regulators who are on the phone here with us today. But I thought I'd just give, Arthur, I'd just give a very brief, more general or high level view, share my screen here, of what we've considered, environmental commodities, and carbon markets are the biggest component of them. So essentially what these instruments are from a trader or an investor's perspective is that these are certificates, tradable commoditized certificates that either represent, on the one hand, a permit to emit or a permit to pollute, and that's what we would call an allowance. So the RGGI market, the UETS, and the California program we've heard about, the regulators in these markets issue these tradable permits. And of course, the point is, if you look back 10 years ago, environmental regulations would have been, you want to build a power plant, you want to expand a refinery that's an emitter, you would go get a static air discharge permit. That would take you quite a bit of time to achieve, and it would be a fairly fixed asset. Here today, in these sort of modern environmental regulatory programs, which we view as quite flexible mechanisms, the point is that instead of you take that single permit and you actually break it down to the unit of emissions, you commoditize that, and you actually make it tradable in the marketplace. So, the point is that we would hope that market participants, buyers and sellers, in a well-functioning and well-ordered market would come together and essentially establish through price discovery what the cost of abatement is, the cost of pollution here. So these concepts, on the one hand, allowances, or on the other hand, the what you would call a carbon offset instrument and the related environmental commodities like RECs or LCFS credits, those represent, on the other hand, a reduction, so the positive externality of a reduction in greenhouse gas emissions that's then monetized and captured and often brought into a cap and trade system as an offset credit. So, or in markets like RPS programs, renewable portfolio standard programs, or low carbon fuel standard programs, you have essentially a baselining credit system. And so these are the fungible instruments that trade. Roughly, if you look across the globe, as of today, probably 22%, 25% of global emissions are covered by some form of these programs. And that really boils down into sort of a universe of about 30 exchange traded environmental commodity markets and many more programs that we expect to come here. We can roughly categorize them as, of course, cap and trade. So we're here to talk mainly about the UETS, California, and RGGI as the largest cap and trade markets, but clean fuel markets, California's low carbon fuel standard, the renewable portfolio standard markets, which create what we call a REC, which is a tradable instrument representing 1 megawatt hour of power, and then even some other environmental commodities that you can really sort of push the boundaries of the policy mechanisms here. So there are environmental commodity programs for other forms of pollutants, NOx and SOx, for example, in the reclaim program in the Southern California Basin, which has been trading since the 90s, a form of pollution permit for nitrogen and sulfur oxides, the sort of precursors to smog and acid rain. So this is a universe, it's a very large universe, but of course the three main markets today, which essentially dominate the bulk of liquidity trading as well as compliance activity, are the UTS, California, and RGGI. Just a few comments quickly on the characteristics, you would say, of carbon instruments. So is that ultimately these are regulatory instruments that are meant to achieve the policy goals, and those policy goals are set in advance, largely speaking. And so what we mean by that is essentially the cap that is intended largely to decline over time. This sets up one major characteristics of these programs, which are that you typically have static or really scheduled supply. So the supply of allowances is determined by our colleagues on the phone here, who are the regulators, largely in conjunction with the long-term policy objectives or the scientific needs to reduce emissions. But that's a static quantity, and we know it in advance. On the other hand, demand for these permits come from emitters, and that's really, you can think about demand as emissions of greenhouse gas emissions, and that's very dynamic at times. So, economic activity, which sectors are covered, the cost of abatement in response to various price signals here creates a very dynamic environment. So when you have, static or very inelastic demand supply response mechanisms that meet a very dynamic demand environment, you can get the opportunity for very, very rapid, quote, repricings in value. And so that's really what we see in these markets over time, is that they can swing from, for example, in the California program, we've seen many, many years of staying at the floor price where there is a regulatory construct like a floor price, but then they can rapidly reprice as EUAs have shown in 2016, 2017, 2018, and now again this year. So the programs are often young and they're complex, so there are market inefficiencies that do lead to differing behaviors. Some entities in these markets are sort of nominal emitters. Typically, for example, the threshold to be captured or regulated by the California program or the European program is around 25,000 tons a year of greenhouse gas emissions. So that's a 2 megawatt a power plant essentially on the top of a hospital or a university campus, such as your own, is already likely to be the scale of a cap and trade entity. But then, of course, it goes all the way up to the large refineries, the large power plants, aviation emissions, and so forth. So these the economics of reducing emissions or managing emissions and compliance really do lead to predictable price formation and behavior at times. And the other major characteristic I would draw your attention to is that unlike other commodities where you have actually a physical real commodity, such as oil or natural gas, which is consumed on an ongoing basis to run a power plant, to run a refinery, to produce industrial output, these emission permits are really, they are usually generally once a year, sort of the physical consumption of them, which is the active compliance. So the surrender dates often are annualized. And so you have essentially what we would call a calendar instrument that emerges here. And so a calendar instrument means that on the margin, you don't need to actually purchase, if you're an emitter, the credit fully today, because you can wait closer and closer to your compliance date to actually expend the dollars, especially in a high price environment. And so essentially this characteristic of a synthetic commodity, it's not a physical commodity that was consumed in real time, but it's an annualized synthetic commodity that's consumed maybe over the course of the year. In California's program, that's actually even more a triennial, every 3 years, a compliance window. That leads in many ways to a futures forward market. So these markets do tend to naturally accrue towards futures because large emitters can use exchange traded instruments to manage their price risk throughout the year, but in a very capital efficient way, and actually only take delivery where they have to pay the full notional value of those instruments towards the end of the compliance cycle. So these are just a few characteristics that are really kind of unique to these markets, whether it's EUAs or CCAs for California or RGGI instruments and others. And that often leads from the investor's perspective to these instruments behaving differently from other financial assets. So we could consider them uncorrelated in many ways. And that provides an attractive element of diversification to investors in their portfolios. Inflation hedging characteristics from that constrained supply construct to these markets. And so often you see these instruments behaving in idiosyncratic ways and not necessarily correlated to equities or debt or bonds. Very quickly on, just in the interest of time here, the participants in these markets, we would still argue, are dominated by the compliance entity, what we'd call the emitters here, or the naturals of the market. So that depends on the construct of the market. California's program is, as we've heard, it's economy-wide. So the largest component are actually the fuel producers, the refineries, the importers. We also have the power sector and the industrial sector in California. But for example, in California, our heavy industry is long gone, and it's largely a service-based economy, with the exception of a few industries like oil upstream production or cement. And so in California, the cost of abatement is largely going to be driven market-wide by the signals that are coming from the transportation sector. What does it take to decarbonize transport? And there we often see very, very high prices needed to really incentivize decarbonization in the transportation sector, just to do the economics there. In the UETS, as Casey kind of mentioned, and I'll show you just really quickly again in the next slides, you have a characteristic of fuel switching, because you have large amounts of coal and natural gas still on the grid. We don't really have coal anymore in California. So there's both long-term abatement opportunities, but also fluid short-term abatement opportunities. And the compliance cycles and hedging patterns of these emitters really do dominate price action. But you do have financials. So largely lumping them together, I would consider there's really 3 or 4 types of financials that are active in these markets, or intermediaries, if you will. You have short-term speculators, as you might expect in other commodity markets. Not all markets afford this. So for example, California's low carbon fuel standard market is a closed system. You really do have to be a natural or a producer or a consumer of credits to be into the system. But in most markets like the CCA market or EUAs, they're open largely to all sorts of market participants in the financial sector. You have thematic long-term investors, such as investment funds or institutional investors who may look to use a carbon instrument to hedge their exposure to emissions that are embedded elsewhere in their portfolio. Logic is that carbon prices are sort of directionally skewed upwards in time, and so that can offset increasing liabilities on a fossil sector or fossil allocations in institutional investors' portfolios. We also have a robust cash and carry market, which is common to many commodity markets, but these are where you have essentially investors who are looking to capture the yield or the contango in the market. So by buying physical spot certificates, selling one-year forward futures, and locking in that spread, that's a form of liquidity providing to the market. And you see a robust sort of cash and carry component to these markets as well. And that's led to, among other things, well-developed derivatives and options markets for all 3 of the primary markets we're talking about today. Finally, just two quick seconds on what is the point of these markets longer term. We definitely say the point is to drive abatement. So to price CO2 emissions and to drive abatement. And as Casey kind of illustrated, the biggest opportunity set in Europe in the near term has been the coal to gas fuel switching. And while that's not occurring really in a functioning way at the moment, just due to extraordinary high gas prices, this is what we would consider, real abatement happening in the near term, where you look at the perspective of a power plant, and what we call the sort of revenue or the profit equation of the power plant is to look at the revenue side, and you have the cost of the electricity, the value of a megawatt hour, and you have to subtract the input cost. So traditionally, in most markets prior to the advent of these programs, the input cost was the cost of the coal or the cost of the gas. And if you look through sort of a character through history, this is Germany through history in time, you see essentially that it's always more profitable to run coal than gas to produce power if CO2 prices are 0. Now, if we switch ahead, and then we call that the dark spread and the spark spread, very basic character, but this is how power is often dispatched. But if you add in now a CO2 price cost, so now you have the revenue is still the same unit of power. It may have gone up in price, but it's the same unit of power. You now, as a coal or a power plant operator, have your input cost of coal, input cost of gas. Now you also have an input cost of the CO2 permit. And the key thing here is obviously renewables, nuclear, large hydro. They don't have to pay that permit, so they just get the profit of the electricity. But if you're coal, you have to have roughly 1 permit per megawatt hour, whereas if you're natural gas on a character basis, it's roughly half a permit per megawatt hour. So that differential input cost on the CO2 leads to what we call the clean dark spread for a power plant that's a coal power plant that's optimizing its carbon costs, or the clean spark spread for the gas plants. And the point is that the CO2 prices can shift this merit order, this curve to time, where you see real abatement here, where natural gas fired power generation goes ahead of coal in the fuel switching process. And that is real abatement that is incentivized over time. So the purpose of these programs are really to try to incentivize these sort of fluid short-term abatement opportunities, which can happen very rapidly, like in Europe, where you have flex fuel facilities on the grid, or the grid is flex fuel itself, but also to send that longer term price signal to the industrial sector to decarbonize, to install the sort of quote CO2 scrubbers of the future, or in other fuel switching, like Casey mentioned, around green hydrogen instead of other conventional industrial input costs. So I'll stop there for the moment, but very much look forward to the discussion. Thank you.
Thank you very much, Alex. So we had a chance to learn about a number of different carbon pricing systems. And one thing that's really striking, if you look at current prices, they are so different, right? They're kind of in the $10 to $15 range in RGGI. In California, it's sort of in the 20s and 30s. The EU ETS is much, much higher. And that sort of naturally begs the question, does that mean that one is right and the other is wrong? So I'm curious to get the perspective of the various experts here. So Katie, maybe I can start with you. RGGI has the lowest price. How should we interpret that in light of these other carbon trading systems with much higher prices?
Sure. I think that I'll answer it this way, which is to say that in all of our discussions around program review, among the states, when we're thinking about the RGGI program, its stringency, aka how tight the cap is, and which obviously has the impact on the allowance prices. Our conversations always include discussions around complementary programs, and in the Northeast, our states have been investing in energy efficiency through utility administered programs, doing bilateral contracts for long-term contract power purchase agreements to support development of offshore wind and solar and so on and so forth. All of those are investments in decarbonization that are affecting the grid mix, but they're paid for in different ways. And they're certainly reducing the demand for allowances over time. So it's a portfolio of mechanisms that we're using in the Northeast to achieve our goals. RGGI is an important piece of that. It certainly provides a lot of support for nuclear resources, for hydropower, which aren't typically under contract or supported through some of those complementary programs in our states, although that's been changing over time. But I would say that may be one of the reasons for the lower pricing.
Casey, what's your take on this from the perspective of the market with the highest price?
Thanks, and I will just echo Alex's comment, because I think it was really well taken, is that we do have market positions in various markets, so do take what I say with a grain of salt. I think that there are two kind of interesting things to highlight. One is what Katie had mentioned, which I think is really well taken. Whereas in Europe, I think the primary mechanism to decarbonize a large percent of the economy is via the emissions trading scheme system, and that then means that the climate ambition that you've seen in Europe can be directly priced through that mechanism. And I would say that it is probably not for nothing that the European Union itself is on the more ambitious side of the climate reductions that they're going for. Also, and I think Alex complimented and actually presented it even better, the kind of coal to gas switching paradigm. And it would be, I would have to comment that the incredibly high natural gas prices in Europe have done a lot to kind of support European carbon this year. And I would say that right now coal is running ahead of gas in the merit order, and as the regulation in Europe becomes tighter, that's quite significant, right? Because that's the first thing that needs to be accomplished in Europe. And if you're not able to do that, then that means that the price path is still not high enough. And to the chart that I showed before, it's not high enough by a factor of several times. So anyway, all that to say, I think that although Europe has the highest carbon price, and this goes directly to your question, these markets are very hard to kind of compare with each other. They're all different and unique, and you need to run separate balances and think about them each as an individual market. And that goes with the voluntary market, which isn't in discussion today. But I think people like to think about carbon as one instrument, where it's really a variety of instruments.
Thanks. So when I look at California, Emily, what's interesting, and the price is somewhere in the middle, but there's been this recent price spike. In fact, if you pay close attention to Reggie and the EU, prices have also risen quite a bit. So maybe it's always fun to speculate a bit, but like when I look at this from a distance, is it really like, do you have the feeling that like the only way is up? What are your expectations about pricing in the California system?
Well, not having a crystal ball and also not having any position in the market. No, I think it's a great question. This has been a question in California since the inception of the program. What is the right price? And it depends who you ask. Are you looking to have auction revenue? So California has brought in, the sale of allowances have brought in $18 billion over the course of the program, which is really significant and has made a huge impact in disadvantaged communities and reducing greenhouse gases in California, and focusing on these communities that are hit the hardest by climate and poor air quality. So there's a contingent who would like the price to be higher, but then you have to think about affordability and cost pass-through and leakage. And so I think it's a really fine line that you straddle. As you can tell in California, it's been, there's been a soft ceiling and now there's a hard ceiling and the price floor. So it's been a continual discussion, and there is a group of people that would like the price to be higher, but then the affordability argument comes in. So I think it really depends who you ask, and I don't know what this means. I mean, I think it's a sign of, as Alex said, a lot of these reductions are now going to have to come from industrial sectors where maybe the abatement cost is a bit higher. So is this a reflection of that? Is it a reflection that the captive decline factor is increasing, or that there's more limited offsets? I think there's a whole host of reasons, but I don't have a crystal ball, so I don't want to speculate.
No, that's understandable, although I'm still trying to convince Alex to speculate perhaps a little bit. Because one of the things that Casey said, right, the EU already has pretty high prices, say the 60, 70 euros per ton. They might have to be even several times higher with the current gas prices to incentivize coal to gas switching. Are you expecting those types of prices, or should we become a little bit worried that with elections and politics that it becomes really unsustainable politically to have those high prices? I'm very curious what your expectations are. Can we really see carbon prices say above 100 euros per ton?
Yeah, I mean, these are great. This is the crystal ball that you really need to be active in this market. It's very hard to say is the short term, because the tension between higher prices is the sort of inevitable risk of intervention in these markets. These markets are constructed by policy, and they can change with policy. And so while we think in current prices, and I'm more of a student of the California market here, in other jurisdictions than perhaps Europe, in case he can give his view on that. I mean, I find at current levels, we're still in the sort of the tolerance and zones of both California, certainly, I defer to Katie on the view, and Reggie, but in Europe as well. I think, when we're still in double-digit pricing in the near term, I think that this is within the tolerance levels of the design of these programs in the market. So clearly, however, the markets have to function orderly. So as Casey was mentioning, so in the UETS right now, the coal to gas fuel switch is not being incentivized by carbon. the carbon price would have to be much, much higher to really force coal back out of the merit order and gas back onto the grid. The reason this is clearly not happening is because the global sort of crisis around natural gas prices in the short run, as well as the makeup of the EU power grid, which is not as flexible as we might have thought a few years ago in terms of handling the major changes that are coming up. A couple of them clearly notably are Germany's phase out of nuclear power is putting more stress and more focus on where can you get baseload power, in particular in those periods when you have low wind output in Northern Europe or in the Iberian Peninsula. So, what I would say though is that as long as the markets are orderly functioning and they are reflecting fundamentals, and those fundamentals, again, to me, this is an annual or a calendar instrument. So a short-term spike is a little bit less of a concern than really the balance over the year or the longer term. And because you can bank these credits from year to year, typically you do have that carryover in pricing. And so we'll see, will the market, the UA market really respond to how long gas prices stay high and then move up to those triple digit levels? That is going to be a very interesting question to see into next year. Somehow it seems that the annualized nature of the commodity might put the brake on that alone, but we need to see, in California here, I would say definitely at the current prices, there's very little, there's really very little signal that's being transmitted to, for example, the consumer or the end use customer. Your rough rule of thumb in most regions would be that, a $10 carbon price or a $20, so every $10 increment to the CO2 price is roughly 10 cents on the gallon at the pump. So, that's not insignificant. So California has moved, call it from $20 to $30, roughly speaking, in 6 months. So that's another 10 cents on the gallon. That's not immaterial, but it's also well within, crude oil and natural gas and general, refined products volatility as it is. So we still think that's quite healthy, and that's sort of the market is able to tolerate, or the economy is able to tolerate. If things start to get disorderly and break down, though, and for example, in Europe, this coal to gas fuel switching signal, excuse me for the noise in the background, is not being transmitted, then I think that's where the risk of intervention comes in. And the natural question is, is this functioning right, or do we need to go back to the drawing board?
Thank you. But before I have a related question for Katie about RGGI, Casey, I was curious to also get your perspective on, your price outlook for example, the EU ETS.
Yeah, so I think, I'll take the plunge, and I will speculate because I guess that's what I'm paid for. We remain constructive prices in Europe, right? I think Alex highlighted kind of the underlying reasons why that makes sense. I think, the way that we see it is that even if, and I showed that graph about the kind of the longer term coal to gas kind of switching over time, right? And even with kind of forward prices where they are, you're still not going to achieve that most basic transition. I think that from the political risk standpoint, it's something that needs to be kind of thought about and monitored constantly. However, right, I think European politicians, whether it's through kind of various committees or through kind of the signals that they've given to the market, are comfortable with how the market is functioning, and haven't seen reason to think that, let's say, there's a wild wave of speculation or anything that's driving prices. I think that that comment and data is 10 euros ago or 20 euros ago. So we do need to kind of always be cognizant that, at the end of the day, to Alex's point, right, this is prices are transmitted to the end consumer. And it is something that, even though, we can say that power prices in Europe are mainly a function of higher input energy prices, it's still something that that governments do have control over. So it's something that does need to be monitored. I think what is interesting in Europe is that, and we've spoken about RGGIs in California and the different pricing kind of corridor mechanisms that exist in those markets. In Europe, it's much more, and I mentioned Article 29A, it's much more fluid. That ceiling is actually relatively undefined. It is left vague, as so many things in Europe are, to allow policymakers to kind of choose at which level they intervene, which means that there is the potential that that number is either very close to where we are now or significantly further from where we are now, depending on how you do the math, which is exciting. Anyway, to the question, I think in Europe, we remain very constructive pricing. I think it makes sense, but a lot of it does, have to do with the input pricing and kind of making sure that that the supply side through governments isn't changed materially.
Thanks. And Katie, I have a question for you about RGGI, where if you look at the program design, it's almost designed to never become that high, right? Because there's a price ceiling. It's currently around 13. I would imagine that people ask you often about, could that be raised? Could you tell us a little bit from the regulator's perspective about how that would work, and whether you anticipate that there could be a change in the price cap that would make the price more similar to some of these other systems?
Sure. Yeah. So the cost containment reserve, I mean, all of these different elements of the program are fair game for review and discussion as part of our program review process. And, and I think as we, the most important and of course central question of the program review is, where do we go in terms of the cap, in terms of tightening the cap, and then along with that, the CCR, the ECR kind of provide the sort of, the boundaries or the guardrails on either side of that cap. So that'll naturally be part of the discussion. And I think it does reflect, state regulators and policymakers trying to achieve that balance of sending a long-term signal to the market that's aligned with our long-term decarbonization goals. Ensuring, though, at the same time that we're also keeping an eye on consumer impacts, and given that electricity is something families and businesses can't live without, so we have to be very sensitive to that. I will say that for RGGI, just think, listening to the discussion, I think that we have the investment of the proceeds is something that provides us a way to respond to changing or even kind of acute, issues that are coming up, to the extent that, number one, within RGGI, we've provided for a lot of flexibility for individual participating states to make their own determinations about how to spend the proceeds. In our state here in Connecticut, if the proceeds exceed a certain amount, we refund. We invest our proceeds in energy efficiency and in renewable behind the meter solar programs that directly benefit consumers and help them mitigate against high bills. And then above a certain threshold of allowance or revenues, we return that money back to ratepayers. Some states have direct consumer credits, bill credits that they're providing to pass the dollars directly back. We know that efficiency provides a much greater multiplier effect in terms of carbon reduction and bill reductions overall for consumers. But in some states, they've opted for bill credits. That kind of thing becomes really important, not only from being able to support investments in building decarbonization, let's say from the standpoint of an efficiency program, but from the standpoint of being able to go to consumers who are frankly, I mean, the issue is not that the carbon prices are becoming volatile, it's that fossil fuel prices are volatile, right? And people are feeling that right now at the gas pump, on their heating bill, and their electric rates. And so this is in some ways a conversation about how our carbon pricing program gives us a rare tool to provide direct consumer benefits that can help them mitigate against those price swings. So that's part of the conversation, and it goes back to the importance of those proceeds investments to being in the hands of regulators and policymakers who are close to the ground, who can find the ways that make the most sense for the circumstances of their individual communities to invest those dollars.
And finally, Emily, I wanted to raise a question that is also appearing in our chat, which is about program expansion. So I guess the question to chat is like, do we expect to see a nationwide cap and trade in the U.S.? But also maybe more specifically, California used to be part of this Western Climate Initiative, where it could be something like RGGI on a regional scale. What's your outlook in terms of other states, other countries adopting cap and trade?
Well, California still is a member of WCI Inc., and they actually sort of run all the administrative behind the scenes, all the auction platforms and sort of the banking and the tracking system. And so within that framework, Nova Scotia is also a member of WCI Inc., and they have had 4 quarterly auctions. And so, we are starting to see this. We've seen a program spring up in Washington, and California talks to all different states about this. So I think we're cautiously optimistic that there could be expansion. It is a high barrier to do a full bilateral linkage, and you must have a lot of program design features in common. You also can have some variation. Quebec does not have a price ceiling, for instance. But yes, of course, I think we're optimistic, and especially as there have been some discussions at the federal level that haven't really gone anywhere. It really is, I think states are looking to see sort of how they can achieve their own statewide emission targets, and cap and trade, and especially the proceeds, and seeing the benefit of the revenues that can be generated. That's a very attractive reason to look at carbon pricing. So I think we're optimistic, and I do think that there'll be more programs springing up in the next few years.
Thanks. Well, that brings us already to 3:45. It's amazing how time flies. I have millions of other questions for you, but maybe I'll save that for some other time. So I would like to very much thank all 4 of you that you were willing to spend this panel discussion with us. It's been super interesting and informative. It's exciting as an economist to see that once in a while, an idea that economists think about is actually executed in practice. In between all the criticism, and I take some of that criticism to heart. So this was a really fun discussion. I also want to thank the Wharton Risk Center for putting together such a really impressive and interesting conference, and all the attendees for listening and asking good questions. So thank you very much. And I hope everyone has a great weekend.